can't tell you the exact moment that that's going to happen, but this is a Jenga economy. And every time something happens, another piece of this Jenga is coming out. Which will be the piece that they cannot paper over? I don't know. But what I do know is that because we are in such a vulnerable position, and when I say we, I'm really referring to the central banks here. They're between a rock and a hard place. And they don't really know which, if what they do is going to have any impact, because right now they're juggling the repo and the reverse repo markets. They pushed all this liquidity in. It's too much liquidity. They need to pull some out, at least on a short-term basis. But, can they raise rates? Can they run off their balance sheet? No, they can't do it. And what are you talking? I mean, seriously. Seriously, what are you talking about raising rates? The end of 2022 and 23. It's ridiculous, but the markets respond to it. Well, what the central bank is attempting to do, that's called forward guidance. And they're trying to reassure the banks that they're still in control. But as I've shown you many, many times, that's simply, it's still a bit true. It is still a bit true. But that is becoming actually pretty rapidly not true at all. Importantly, there has been an increase in ownership concentration. That's that consolidation that we're talking about. Shocker, right? The three largest institutional investors in the United States now hold a combined average of 23.5% of the equity in listed companies. Why does that matter to you? What do you care about that? Because if anybody wants to exit these markets, I mean, if they really truly are looking out for your best interest and they see a problem and they want to sell stock, number one, I got news for you. You cannot turn a steamship in a thimble of water. So these huge behemoths, well, they can't just sell out a position like a smaller entity or an individual can. They can't do it because it's going to have a major impact on the entire market, and we got to keep these bubbles floating. But if they did, you have the most narrow base of buyer. And whenever you're really making an investment in something that you think you might want to liquidate down the road, what do you want? You want the broadest base of buyer. You want a whole bunch of people and entities wanting that asset. That's what you want. That's what you have with gold, with silver, because it's used across the entire spectrum of the global economy. Has the broadest base of buyer because that is the broadest base of functionality. What they're telling you here in this is that that there is a narrow base of buyer. So when the markets start to implode, if they start to liquidate out into that, it makes it even worse. And then what happens to all those derivative bets on top of that? I hope you're starting to see the problem and why this is so critical to the reset. Because all of this is just a con game and it requires confidence. I'm showing you the truth. I don't have confidence. I lived inside of this system forever. As a banker, as a stockbroker, I have zero confidence in these people because I read this stuff and I see what's happening. And I would always rather be 2 weeks too early, 10 years too early. I really don't care than 1 second too late, because that 1 second could cost you all of your wealth, all of your choices. And then what do? When you lose all of your principal, how do you recoup? Especially for those of us that are near retirement age or already retired. How do you recoup if you lose all your principal? So you're risking all your principal for a minuscule amount of interest. I mean, seriously, minuscule amount of interest. Is it worth it? Well, you have to decide that for yourself. For me, no. Private corporations and holding companies in several Asian economies hold more than 30% of the total equity capital in publicly listed companies. Look at Japan. And I mean, there aren't even, maybe I talked about it here. Yeah, here we go. And globally, the public sector, including central governments and sovereign wealth funds, own 10% of global market capitalization, unless, of course, you're just looking at Japan, who owns 90% of the ETF market. So how good is that? Are they likely to sell, to liquidate? Well, no, because they can just push a button and really create money at will. Does that mean that its value is secure? No, it does not, because these guys are losing control. The wheels are falling off the bus. And I hope you can see that. I hope you can really see this. Because in 2019 alone, the pension funds and all retirement vehicles in the OECD held, so that's 38 major countries, including the US, 32.3 trillion of assets under management, which is 60.1% of the OECD GDP. Well, what's the GDP? GDP is all the money that floats through the entire system, buying and selling, etc. That is a really scary number. Even if you don't realize it, I'm telling you right now, I was freaked out about this. I really was. And so you have to ask yourself, each one of us has to ask ourselves, whose wealth is at risk? My wealth isn't at risk because I'm all in right here. And I hold it and I control it. And I know the lies. And like the Biz said, gold held at home runs no political risk. All they can do is manipulate the spot price. That's what they can do. Why did gold go down? And silver too. I didn't pull up the silver, but it's the same kind of thing. Why did they go down? Because Wall Street's gold is fool's gold. Those ETFs, you think you own gold? You do not. You own shares in a trust that is designed to track this. And in the silver, they changed the prospectus because they couldn't pull a full basket of physical silver in, and yet you still see silver languishing at like 25 and change. I mean, really, this is how they can manipulate it, but they cannot do it forever. They will do it as long as it benefits them, because a rising gold and silver price is an indication of a failing currency.